Hi, I'm Josh Brown. Welcome to Live from the Compound. It's me, it's Michael Batnick, and a special guest today, Nick Maggiulli, and we are going to talk about how to invest a lump sum. Stick around. This is going to be great. Are you done stretching? Okay. Have you ever seen?
I don't know what he's doing. He's making. Let's just go.
All right, Nick. You followed up a great post about dollar cost averaging with something about lump sum investing, and this is a topic that we hear. I don't know, every week, every 2 weeks. A client who either inherited something or sold a business or has been sitting in cash or has just been letting cash pile up. All right, now what do I do? S&P's at an all-time high. I have a lump sum. What's the right move? Do I average in? Do I just buy the market and hope it's not the top? And I thought you came to some really interesting conclusions. What was the most surprising thing that you found out when you were looking at that question?
The most surprising thing was that when you invest, like the longer time period that you go to average in to the market, right, that actually the more likely you are to underperform versus just a lump sum than just putting it all in right away.
Why was that surprising? You know that.
You think that's intuitive, right?
Yeah, Nick, you know that to be the case.
Well, I mean, I kind of knew that now. I didn't know how much it would matter. I thought maybe over 12 months it wouldn't be as... Like, I didn't know that every single month it would keep getting worse. Like, I mean, we know, like, the market keeps going up on average, so... But I think the issue was I thought I would see, like, okay, a little bit of underperformance, and then maybe it would get better, and then it would get really bad. Like, I thought over, like, a 10 or 15-year, like, average would be really bad. But even at 2 to 3 years, it just keeps getting worse and worse.
So you took data back to 1926?
Yeah.
And this is for S&P 500 or global stocks?
I did a 60-40 portfolio, so I did S&P 500 with 5-year treasuries as well.
Okay, so right, so that's another really important component to this. It's not do I buy the stock market or not. It's do I buy a diversified portfolio or not. And so that makes investing a lump sum a little bit less nerve-wracking because you're buying treasuries at the same time. So you're buying kind of a built-in hedge to the stock risk.
Can I jump in?
Yeah, please.
I think that one of the most important parts about this conversation are the emotional aspects. Like, think about where you're getting a lump sum from. You're getting it from deceased parents, right? Which is like the most emotional money ever.
So the money's got like something attached to it.
Yeah. So that's hugely emotional. Or it's from a business, which is probably less emotional, but still has.
But still, it's you. Especially you built it up your whole life,
right?
Like I built this company and now I sold it.
So if you need to dollar cost average in even over 2 years because that's right for you, I don't think there's anything wrong with that at all. Now the problem is I don't think anybody actually does that. Like I don't think anybody actually inherits $250,000 and then over eight quarters is going to put in 1/8. I just don't think that anybody does that for reasons of inertia or just like you're not going to stick to the script.
So what do you think happens? Somebody invests 25, then 3 months go by, they put in another 25, then the market corrects 10% and they stop putting money in.
Maybe, I don't know. Life gets in the way. Like this is not front and center in most people's minds.
Right. So over 5-year periods of time, how rare is it that DCA, dollar cost average, is better than just putting the whole lump sum in?
Just 5% of the time. So
95% of the time it's wrong.
Yeah.
But again, we're just talking dollars. Like this is just pure math, and obviously the numbers are what they are. Mm-hmm. But I think that there's a much bigger component to lump sum.
Well, there's the emotional aspect to it. I agree with that. But then it's like, then maybe you should have a portfolio that just has less risk in it. If you're really worried about like a 20% drawdown or something, then you should just have a portfolio with less risk and put it in now. I mean, with this post and the last post about, even God couldn't beat dollar cost averaging, the takeaway is get your money in the market now because it's just the market.
All right, but even after this rally, even with the VIX at 15, even with the CAPE at 32?
Yeah, I don't. Are you unaware of what Fed Chair Powell had to say?
I don't care.
Have you seen the debt?
I don't care.
Have you read David Rosenberg lately? I don't know. There's a cereal-driven recession.
Then have more bonds.
People are buying less cereal.
Have more bonds then. That's what I would say.
Negative real rates? What are you, nuts?
So what are you saying? You don't want to lose money, but you want to make money? Which one is it? Do you want you can't have both. Like you either going to risk some money in the short term or you're going to I don't see which way you can get out of this.
In this yield curve environment, you would tell me invest the money.
I would invest the money, yes.
Okay. Do you think that's a good point where you say and you did something on this recently about drawdowns for different ratios. If the prospect of losing 20% in a 60-40 portfolio is so emotionally nerve-wracking that you have to wait 8 quarters to invest, then maybe 60-40 is inappropriate to start with.
Yeah.
I think that could be an interesting idea, that get into the market in a way conservative way, even if it's like 30-70, just to get yourself in.
Just to not be sitting in literal dollars.
Yeah, I think the longer
Chewing your fingernails.
the longer you're in cash, the worse it is, because that's just like mental poison, I think. Because then you're waiting for a pullback, and if it doesn't come, and then if it does, you probably want it to go more. And
Do you know what kind of asshole you turn into also when you're all in cash? Like you're like rooting for horrible things to happen. You're mocking people on down days for the market. To talk about emotional. People get emotionally attached to their pile of cash, which really almost changes your personality. So you definitely want to avoid that pitfall. All right, listen, it was a great post. We're going to link to it in the show notes. Mike, it was pretty good, right? And if you have any comments, any feedback, let us know what your thoughts are. Lump sum versus DCA. It's a huge topic. There are a lot of different ways to think about it. And we will talk to you soon.